Financial regulation has never been a steady accumulation of wisdom. It has always been written in the aftermath of damage. When I trace the evolution of financial regulation, I do not see a rational march towards safer markets, but a recurring cycle of excess, collapse, outrage, and reform, followed inevitably by forgetting. Regulation is not born from foresight. It is born from humiliation. Each generation tightens the rules, not because it understands risk better, but because it has just learned painfully where trust was misplaced. In the ancient world, finance was regulated through moral codes rather than formal law. Lending at interest was often viewed with suspicion or outright hostility, not because societies misunderstood finance, but because they understood it too well. Debt could enslave. Credit could concentrate power. In Mesopotamia, periodic debt jubilees were enacted not out of mercy, but to prevent social breakdown. In classical Greece and Rome, laws attempted to limit usury and protect citizens from permanent debt bondage. These were early recognitions that unrestrained finance could destabilize the very societies it claimed to serve. Regulation here was crude, but its intuition was sharp. Money, left unchecked, corrodes cohesion. Medieval Europe carried this moral inheritance forward. The Church condemned usury, while simultaneously enabling commerce through loopholes, partnerships, and merchant law. Regulation operated through social stigma as much as statute. Who could lend? Who could borrow? And at what cost were questions bound up with identity and legitimacy? What mattered was not efficiency, but order. Finance was tolerated only insofar as it did not threaten hierarchy or moral authority. This tension between necessity and suspicion would define regulation for centuries. The early modern period forced a reckoning. As trade expanded and states grew hungry for capital, moral restraint gave way to pragmatic governance. Governments began to regulate finance not to suppress it, but to harness it. Chartered banks, monopoly trading companies, and public debt markets emerged under state oversight. Regulation became selective privileges for insiders, constraints for outsiders. The Bank of England, founded in 1694, was both a regulatory and fiscal instrument, stabilizing credit while financing war. This era taught a lesson still visible today. Regulation often begins as a partnership between state and finance, not as a restraint upon it. The 19th century transformed the problem entirely. Industrialization multiplied the scale of finance, while liberal ideology celebrated markets as self-correcting. Regulation retreated just as complexity surged. Banking crises, railway manias, and speculative panics erupted repeatedly. Each collapse revealed familiar patterns: opaque balance sheets, insider advantage, and the socialization of loss. In response, regulation crept back in piecemeal company. Law disclosure requirements, limited liability, each designed to patch a specific failure without questioning the system as a whole. Regulation became reactive and fragmented, mirroring the markets it sought to govern. The Great Depression marked the most decisive regulatory turning point in history. When markets collapsed globally and unemployment soared, faith in self-regulation evaporated. The scandals and excesses of the 1920s were exposed, publicly humiliating financial elites and delegitimizing laissez-faire doctrine. Governments responded with sweeping reforms: securities, regulation, banking, separation, deposit insurance, central bank authority, and oversight bodies designed to enforce transparency and discipline. This was not a technical adjustment. It was a moral reset. Finance was redefined as a public concern rather than a private game. Stability became a political mandate. For several decades after World War II, this regulatory framework held. Banking was boring. Leverage was constrained. Innovation was slow. Growth was shared. Regulation did not eliminate crises, but it reduced their frequency and severity. This period is often remembered nostalgically, but history reminds us why it worked. Memory of collapse was fresh, and political power favored restraint. Regulation thrived not because it was elegant, but because it was feared to remove it. As memory faded in the late 20th century, regulation once again came under attack. Inflation, stagnation, and globalization made old rules feel restrictive. Financial innovation promised efficiency and risk dispersion. Deregulation was framed as modernization. Barriers fell between banking activities. Capital moved freely across borders. Oversight lagged behind complexity. Regulators trusted models. Markets trusted ratings. Everyone trusted that lessons had been learned. History rarely forgives such confidence. The global financial crisis of 2008 shattered this illusion. It revealed that regulation had not disappeared. It had been hollowed out. Rules existed, but incentives overwhelmed them. Risk migrated into shadows. Institutions grew too interconnected to fail, and failure was absorbed by the public. The response echoed earlier: cycles outrage reform and renewed regulation. Capital requirements were raised, stress tests introduced, systemic risk acknowledged. Yet even as rules tightened, complexity remained. Regulation struggled not with absence, but with speed. What emerges from this long arc is a sobering pattern. Financial regulation expands after crises and contracts during booms. It is strongest when memory is fresh and weakest when confidence is high. It is never neutral. It reflects power politics and prevailing narratives about risk and responsibility. Regulation does not prevent innovation. It shapes where innovation flows. When regulation is tight, finance becomes conservative. When it loosens finance, becomes inventive and dangerous. Today, regulation faces its most complex challenge yet. Markets are global. Products are abstract. Technology moves faster than law. No single authority governs the system. This creates a paradox. Finance is systemic, but regulation remains fragmented. History suggests that this tension will not be resolved cleanly. Instead, it will produce new cycles of excess and restraint, each justified as necessary, each incomplete. And it is here at the edge of our current moment that the evolution of financial regulation reveals its deepest truth. Regulation is not a solution to risk, but a negotiation with it, a constantly revised boundary between private ambition and public consequence. And as long as finance remains a human enterprise driven by belief, fear, and power, that negotiation will never end, but will instead move into its next phase, shaped by new technologies, new crises, and the same old lesson that rules are written only after trust has already been broken. And the story continues into that risk reshaped by technology scale and the fading memory of past disasters. In the contemporary era, financial regulation no longer struggles with a lack of rules, but with an excess of speed. Digital trading, algorithmic decision-making, shadow banking, and global capital flows move faster than any supervisory framework designed for institutions rooted in national borders. This creates a familiar but intensified dilemma. Regulation arrives late, while innovation arrives early and leaves footprints only after damage has been done. History suggests that every major financial innovation eventually forces a regulatory reckoning. Derivatives were once obscure contracts between specialists. They became systemic weapons when embedded in leverage and opacity. Securitization promised diversification. It delivered correlation. Today, fintech, cryptocurrencies, and decentralized finance repeat this pattern in new language. They emerge framed as efficiency and inclusion, operating at the edges of existing rules, attracting capital precisely because oversight is unclear. Regulators hesitate, fearing to stifle progress. Markets interpret hesitation as permission. This is the ancient rhythm repeating itself, accelerated by code. Another enduring tension lies in the political economy of regulation. Financial systems generate powerful constituencies that benefit from complexity and discretion. Regulation that genuinely constrains profit invites resistance framed as competitiveness, innovation, or national interest. History shows that regulatory capture is not corruption in the narrow sense, it is alignment. When finance becomes essential to growth, employment, and state funding, restraint becomes politically costly. Rules are softened not because danger is unseen, but because confronting it threatens short-term stability. Crises, when they arrive, reveal the cost of this compromise. At the same time, regulation has evolved in sophistication. Stress tests, macro-prudential oversight, capital buffers, and resolution regimes represent real progress. Unlike earlier eras, regulators now acknowledge systemic risk explicitly. Yet this sophistication brings its own fragility. Complex rules can create blind spots. Models assume behavior that changes under stress. Institutions optimize against regulation rather than risk itself. History warns us that when compliance replaces judgment, safety becomes performative. What the long history of financial regulation ultimately teaches is that stability is not achieved through permanence, but through adaptability anchored in memory. The most resilient systems are those that institutionalize doubt, that assume failure is possible, and design for it openly. This requires more than laws. It requires cultural restraint, political courage, and public understanding that finance is a means, not an end. As new forms of money, credit, and coordination emerge, the next phase of regulation will not be defined by tighter rules alone, but by clearer boundaries around public responsibility. Who bears loss? Who receives rescue? Who benefits from risk-taking? And who absorbs its cost? These questions have echoed since ancient debt jubilees, and they remain unanswered because they are not technical, they are moral. If this journey through the evolution of financial regulation has sharpened your understanding of why rules exist and why they so often fail, I invite you to subscribe and continue these historical explorations with me, and to leave a comment, sharing which modern financial innovation you believe will force the next major regulatory reckoning, because history shows that regulation never ends excess, but it can decide whether excess destroys society or is absorbed, learned from, and transformed into a more durable order.